Hello and welcome back to Crypto Clarified. My name is Vinh Tran, Associate Director of Business Development at WisdomTree Digital Assets.
And I'm Dovile, and I'm responsible for digital asset research at WisdomTree Europe.
And today we are joined by our very own Blake Heimann from WisdomTree. He's the Associate Director of Quantitative Research, and we're going to be discussing all things macro across crypto, across TradFi, and everything in between.
Hi, Blake. Great to have you here among us. And today we're here to talk about WisdomTree Market Outlook that we just published. In that outlook, we have crypto section that's called Discipline Wins. And the key message of that section is that small allocation to crypto makes sense within a multi-asset portfolio. Would you mind just talking about this? How investors should think about, making a small allocation and what they should consider, how everything may look like for them.
Hi, Dovile. Hi, Vinh. Yeah, thanks for having me on. Diving right into the meat of the conversation. So I'll start really high level, just without maybe getting into too much of the, I'll say the quantitative side, because, it's as much as that's super helpful and we want to focus on that. And we do have some, white papers covering the topic. But like at the really high level, we just really did a lot of research behind the scenes to kind of take a very naive starting point of just looking at the universe of assets out there, start to kind of assess how big the crypto ecosystem is, and realizing that, given the actual size of the market, we've seen the peaks at 4 trillion or more in market cap, now down to 2.5 to 3. Like, that's roughly when you kind of look at what the liquid, say, market portfolio in terms of like a market cap weighted opportunity set of the things you could invest in as like a traditional multi-asset investment manager. You see that's about 1% of a potential kind of market cap weighted multi-asset portfolio. So just starting with that's just a really interesting way to start thinking about, introducing a small amount of crypto in a portfolio. And then when you kind of run the, historical back tests and even forward-looking analytics, you find that, even if it is a volatile asset class, it's one that is decorrelated. And obviously, if you've had strong performance like we've seen over the last decade or so with, 50-ish% annualized return for Bitcoin over that long-term period, you get the benefit, obviously, of the excess return that it's driven in the past, but also even with the high volatility. And I think it's interesting, Dovile, we should talk about kind of the change in how the volatility has evolved over time as institutional adoption's taken place. But because of the decorrelated nature, even if it does have a higher vol than you're used to in, say, traditional assets, it tends to be very negligible at the portfolio level. So really only increasing your portfolio vol by a few basis points. But then obviously, when it comes down to if you do have positive returns and you start to take these into account in your forecast, you see that it'll actually allow you to move out on the efficient frontier, because you're essentially getting the diversification benefits that could, reduce volatility, but also tapping into a new return stream that's not correlated with your other assets in the portfolio. So this is what a lot of people are kind of looking at it from like the quantitative perspective, but it's really kind of just early days for a lot of institutional investors as they step in, and this is one of the things that they look at.
You touched on an interesting point was, yes, volatility. It has compressed as more institutional investors have allocated to Bitcoin. So towards the end of last year and at the start of this year, it was below 40% on 90-day annualized basis, which is incredibly low when you take a look at Bitcoin's historic volatility. But now, just knowing what's happening in the world, Bitcoin's volatility is back to 60%. So it's getting closer to the average, just because all the markets, including crypto, are reacting to various geopolitical events around the world. But that does not change what you have been saying up to now, which is, while Bitcoin is quite volatile, it's very uncorrelated to traditional assets. So having small allocation within a multi-asset portfolio tends to improve the risk-return metrics of those portfolios. But
Yeah, and I was just going to say, as you alluded to with the reduction in volatility, like as we've seen more institutional investors move into this space, we've seen them have a little bit more, I'll call, staying power, because as you've highlighted in our outlooks and other conversations, is that these investors come in with a very, I don't want to call it rigid, but a very strategic, I guess, strategy around their allocation here. Strict rebalancing timelines, strict risk mitigation rules, whether it's addressing the drawdowns, the volatility targeting, all these types of things that people are taking into account at the institutional level is helping, reduce a bit of that, I'll say, additional volatility that's tied to that sentiment that has historically driven really strong moves. So we've seen, even in this recent drawdown, I mean, in the previous cycles, we've seen drawdowns of 70+%. So far, we're, roughly 50 or so percent off the peaks for at least speaking in terms of Bitcoin. So when you kind of look at it that way, I think, that helps kind of speak to, the institutional adoption that's taken place, but also kind of back to the portfolio construction side of things really quickly. Like, we've done some forward-looking analysis and taken into account some assumptions where, we do expect the asset class to continue to be adopted and continue to have, maybe potentially even slightly higher correlations with other assets as it becomes more and more of a prevalent staple in a portfolio, as well as having potentially a little bit reduced volatility like we've seen over the last few years. And, even with that, it just warrants, when you start to do some more advanced portfolio theory and portfolio optimization, that generally you just need your crypto to outperform, say, your equities by as much as 4 or 5% to actually warrant a small allocation in portfolio. So it's and when you think about what that means in terms of in terms of thinking about what is excess 5% excess performance versus equities. Like, if equities are expected to perform 10% a year, or let's say 9%, that would be 14% for crypto. And that means it's doubling every 5 years. And if you've been in the ecosystem at all, you've seen that the years that come by, either crypto's flat to down significantly or it has doubled. So this is where, it really, fits into the portfolio quite nicely. And when, we can get into the investment thesis behind a lot of the assets and kind of the other things that now have come to a different investor's attention, whether it be, maybe staking and this concept of, capturing the total return tied to some of the other assets in the space. But, just looking at it at face value from a quantitative perspective, this is where institutional investors are looking and finding a lot of, strong insights that point to having those small allocations.
So I think double clicking on that, and honestly, Blake, this conversation, I've been looking forward to this conversation because, to your point, given the prices, I think the vibes generally in the ecosystem right now is very muted, to say the least. But when you see volatility like this amongst Bitcoin, amongst the other altcoins, per se, how do you explain that volatility? I think it's clear that when you compare, obviously, 70% drawdowns to now 50% drawdowns, you can point to a more institutional like adoption that's causing, let's say, maturity of the asset. But how do you explain a 50% drawdown to investors?
Yeah, no, that's the tough one. I mean, we can look to very specific events that have taken place, like, back in October, the major liquidation event that took place that wiped off, several billion worth of value just in a single day. I mean, at the end of the day, this asset class is heavily impacted by the macro environment. And, as you start to kind of move out into, I'll say, just kind of the decentralized infrastructure that's out there on some of the trading platforms that allow for significant leverage to be taken, through some of the, I would say, honestly, a lot of those innovations that enable that excessive potential leverage and, I'll say the margin calls that are being made, all of these things, the technology enables these, whether they're traditional firms or if they're decentralized, literally protocols running, it allows for this innovation to take place to enable these things because it's on a unified data layer, which means you can have these automatic liquidations take place before, the centralized entity that is, say, managing the exchange, et cetera, takes a loss. So it creates an opportunity for new, I would say, newer use cases, more users to come on board into this that's traditionally, I would say, the more unregulated ecosystem that's out there. But with it comes, as I kind of alluded to at the start, is like you do have excessive leverage and potentially more or less, I'll say, inexperienced or different levels of experienced traders being involved there that are subject to these massive changes in what we've seen in the market environment more broadly. So when there's, shifts in, expectations for monetary policy, geopolitical risk, crypto is really the furthest out on the risk spectrum in terms of kind of what you're investing in. What most people will think about duration of assets. Like when you think about quote unquote discounting the present value of any of these assets back to their perspective, their proposed fair value. I mean, traditional equities, you're doing that with their cash flows, and if they don't have, if they don't actually have cash flows being generated, it's zero until they actually can prove that they're going to build the business model that generates those cash flows in the future. And similarly with crypto, it's really hard to value these things. So you essentially have a really high discount rate on these types of assets. And anytime you get these risk-off events, this tends to be one of the asset classes that gets sold first to meet, to move into safer assets. So now I think there's different types of specific crypto assets that will move differently because of their different use cases, their different investment thesis. But at the end of the day, when you're kind of comparing it to equities, fixed income, commodities, these have been around for in the shortest period, you're talking hundreds of years to thousands of years when you're thinking about gold. So people are very familiar with kind of understanding and thinking about these from an investment perspective, where we're looking at really under 20 years for all the crypto ecosystem. So it feels, for those of us that have been in it, it feels like it's been a long time, but like from the like real like longer term perspective, this is still very, very early days for this technology and this asset class.
Blake, I agree. 1 year in crypto feels like 10 years in the traditional world. But I think you made an interesting point about technology enabling new activity. And then technology matters a lot on your side with tokenization. So when you talk to your investors, like how are they viewing all the developments that are happening within tokenization space, and what are the expectations for the next 12 to 18 months on that side?
Yeah, that's a great question. To kind of level set, I think Blake alluded to this, but with technology, it feels like a double-edged sword, right? Where you have this innovation, you have all these new types of assets and new types of trades that are possible when it comes to leverage, but then October happens, and that can obviously scare a bunch of folks institutionally and retail. But within the U.S., at least, how we see tokenization is that next frontier of finance, right? We see it as a new wrapper. The story that we like to tell here is what can do to ETFs what they did to mutual funds. And the answer to us is tokenization. And Blake said it best, one platform that unifies access. And to us, that's the main goal of what we're building here, is that access point. And we see tokenization as a more efficient way to sell, to trade, to buy. And I think in the end of the day, it really is about control for individuals and for institutions, which in my opinion is extremely exciting use case. And for anyone that wants to get into space, that's curious, I tell them all the time, just download a wallet, see what it's like to work on blockchain rails, and you'll know instantly why this is the more favorable, just better experience. It can seem overwhelming at first, obviously, when you talk about private keys and, it's just a 12 digit, not 12 words. And, it seems scarier than it is. But I think and that's the gap too, I think. So to Blake and what you guys are doing on the crypto ETP side, I think for institutions, there is an infrastructure gap, and retail too, at least for mass adoption, that we're missing. When maybe one day I don't have to worry too much about the private keys, and I could just manage and control my assets in this one centralized place. That's the future that I'm very excited about.
And just for listeners, I can highlight this in a very visual picture. What we do in Europe is we take new wine and put it into old bottles. And what they do in the US is they take old wine and put it in new bottles. Agree, Vin?
Exactly. That's exactly what we're doing. And
So
they
it's like
both
this.
taste phenomenal, by the way. They both have their use cases for their buyers.
Agree. It's interesting use case. But now going back to you. So towards the end of your point, you mentioned the staking yield. And I always, when I talk to investors about crypto investment, I say that they should treat crypto no different than they treat equities where they care about dividend yield, no different than they treat bonds where they care about fixed income yield. So can you talk to us briefly about what staking yield is and how it helps to create the total return, you know, environment within crypto space?
Yeah, for sure. So at the highest level, like, let me start with saying what staking yield is not, because this is where people can get sometimes confused. Is that in traditional finance, the assumption is that if you're generating a yield, there tends to be, some sort of, um, I'll say a very familiar risk set that's attributed to that. A lot of times people think, oh, you're lending, you have to be lending to generate that yield, which in crypto, that is definitely possible, and we see that in certain places. But it's more often that but it's true. It's more true when you're speaking about staking, that it's more you are taking that your assets that you hold currently to then put those up as collateral. So rather than say lending, you're essentially just kind of posting them as collateral to the network while you do validation of the transactions on the network. And really, it's just an incentive mechanism for people to validate transactions to ensure the sanctity of the network. So when you send assets to Dovile's wallet, that transaction goes through, and it goes through from an accurate, it goes through accurately, and there's no fraudulent type of transactions being put into the blockchain, for the length of time, because obviously these things are immutable. So when you're participating in that validation process, you generate essentially a yield. Some of it comes in terms of a fee, depending on the blockchain, that is paid in transaction fees, but other times it's just purely inflationary, newly minted cryptocurrency tokens. So in that regard, you end up getting paid for doing that activity, which ends up generating that nice yield. Now, in terms of Dovile, as you said, like sometimes there's not we kind of think of it as the total return, because there is some nuance with this. Like at the end of the day, you're just running software to do this. So it's not like you're, physically having to do like labor, or it's not like some crazy laborious type of thing. It's really just, I just need to make sure I have the infrastructure set up to run the software to participate in validating on the network. And then, you generate that yield, which is great. But there is, some risk tied to this, because in some blockchains, you do have to, you are subject to an unbonding period, which just means, if I'm going to post my collateral, I do I do the process of posting the collateral. And then from there, if I actually want to withdraw that collateral to no longer participate in staking, um, it might take some time to do that. So that's like one of the things that you kind of have to be mindful of, which is when, if we're speaking about, you talked about the wine bottles. If you think about moving it into moving, I'll say the new wine, moving the crypto asset into the old wine bottle, and the old wine bottle being the ETP structure, like, we have to be mindful that the underlying asset is, being rendered illiquid for that unbonding time period. So this is one of those things that, a lot of times, only a portion might actually be staked to generate that yield, to make sure that there's daily liquidity at that ETP level. So it's just something that I would say, to kind of step back as bigger picture, like, is now becoming much more prevalent from the institutional asset manager perspective, to become, or sorry, the awareness has risen so much more, because of the asset class being much more common in their portfolios. And now it's going beyond just, oh, I just want Bitcoin to, have a starting point allocation. Now they're moving into spaces like Ethereum, Solana, and further down the market cap spectrum, where there are these yields, and they're saying, oh, I can actually, if I have a long-term view and I want to hold for the long term, why am I not actually tapping into this full or this total return stream? So this is where, a lot of those questions get brought up and a lot of this, gets discussed in meetings.
I'm actually curious. So when you're having these conversations, you talk about it as if it's very simple, right? You're just running technology and you get to earn this yield. So for the institutions that you are talking about, how do you see that evolving? Because I, from a staking perspective, we can wrap that to your point, right? Put it in an old bottle and sell that exposure, staking exposure versus doing it yourself. How is that evolving amongst institutions?
I think this is where it's earlier stage to think about, I would say enhancing that overall the liquidity of that so you can generate that full total return, if you will. So there are smart contract based solutions, and maybe this is where Dovile can jump in and talk a little bit about, some of those that are out there, like, the Lido protocol is a good example of this. There's other ones that are out there. I would say, maybe smaller cap, but the actual smart contract based type of solutions that are can be deployed to tap into this staking and enhance or create an additional secondary market to enhance liquidity to tap into that total return so you can accrue the full value without necessarily having that immediate I'll say illiquid lockup. Now there is obviously still that you're not really getting away from that illiquidity, but you get a second layer of liquidity through an additional secondary market beyond just the ETP structure through other types of tokens. So, Dovile, I don't know if you have any additional thoughts or anything you'd want to add there.
Yes, very much so. So the key point for everybody to understand is if there is a standard, let's say a standard ETH that's staked within the ETP, then the issuer needs to manage that liquidity risk that Blake was talking about. Because it's very, very important for exchange-traded product to have daily liquidity because it's listed on regulated exchanges. And it's very important for investors to be able to redeem their money when they need to or when they want to. But we talk to investors who say, fantastic wisdom tree, you're taking very risk managed approach, but I want more staking yield. I want as much of its native staking yield as I could get, but I do not want to invest into it directly and manage the staking myself because that's just not in my skill set. So for those investors, there are now products that invest into liquid stake tokens, such as Lido, that remain staked 100% all the time. So investors now have an option to choose a product that gives them the best return while not removing the liquidity of the product that they need to manage their investments. But then it would be very interesting to hear about how yield or some returns work in tokenized space.
Yeah, and it's interesting because it feels like we're going the other direction, right? Where we're bringing, we call it RWAs or real world assets, but really what it is bringing traditional exposures, products that you and I know, and Blake too, that I'm sure we're all invested in now, but bringing it on chain. And I mentioned it earlier, but I want to harp on it. But the idea is really about access, is because I think for the first time, crypto native investors, where you guys are working with more, we call it TradFi institutions. Now, crypto native investors are seeing, we're seeing more appetite for these traditional exposures, like a money market fund, like an equity fund. These are products that I think, traditionally speaking, crypto native people or institutions, it was very difficult to get on chain. So when we talk about maturing space, we talk about diversification, and I think as more institutions come on chain, it's really about optionality, right? So when you're talking about ETPs for crypto ETPs versus more traditional exposures on chain, I think having that level playing field of blockchain, one infrastructure, one platform, you can start playing around with these types of exposures, right? And then talking more on the yield source, it's just a different yield source. Uh, in your guys' world, it's staking. In our world, they're traditional mutual funds that we just brought on chain. And it's interesting to see that dynamic because it's really the world is converging towards this unified world. And to have, open source platform where this is really accessible to all globally. I think that's it's really, really cool to see.
Dovile and Vin, if you don't mind me jumping in here with a question, I'm just so one of the key aspects of this whole, um, I'll say just adoption wave, whether it be at the institutional level of say of crypto assets or even from the side of tokenization. I mean, we've seen here from the European seats a lot of really the regulatory, particularly in the UK, the regulatory front shift quite quickly, which has been very good to see, and that's helped increase adoption. I know we've seen the stablecoin bill, and now we're kind of waiting for the Clarity Act. So, Vin, I'm just curious from the tokenization perspective, what what do you like? I guess how has the stablecoin bill in the U.S. kind of unlocked what you guys are working on over there, as well as how do you see the Market Clarity Act kind of furthering things along there? Because that's another key part of the way that we look at the outlook and look at the space growing is obviously the regulatory side needs to continue to evolve.
Yeah, absolutely. I think that's a great question. And it's something that we're obviously following very closely from the Wisdom Tree perspective. To me personally, what it's really about is the regulation is about clarity. Um, Clarity Act. But the idea is once institutions that are building in the space, startups, new protocols, I think we're seeking regulation, and the misconception about crypto is that we want to live in this lawless land, and I don't think that's true at all. I think what it is it's innovation and technology, but the ability to build in a way that you're not fearful, right, of getting a Wells notice or not fearful of breaking the law because we are in uncharted territory. We are in this space where because of this new technology, we don't know how to classify certain things and the industry doesn't believe that it is classified based off traditional definitions. And I'll give you one example. I'm sure you heard of the term vaults. They've been the biggest thing this year, at least from a narrative perspective. And the idea of a vault is there are many different ways to explore it, but you have lending vaults that can act as collateral for different types of assets. In our world, RWAs, in your world, crypto assets that can sit as lending collateral. On the other side, you see it as an access point to a diversified portfolio of sorts, but it all sits, again, going back to the technology piece, it all sits in this smart contract infrastructure. What is that? Is it a fund? Is it just a smart contract? Is it a platform? And I think that is something that the industry is missing because before we can understand what that is, and this is just one example, how can we as a regulated broker-dealer, securities, asset issuer participate in those types of markets, right? And I think that's the biggest unlock is regulation because it's how we could then start building with this new technology.
No, that makes a lot of sense, and I think I would kind of relate to that from the even from the staking conversation, like, and even as you step further out into other assets, like Deville, another big topic is really just broadly about indexing and opening up the broader access space to other assets that move further down the market cap spectrum. So we've kind of seen how a lot of the focus has been on Bitcoin to start. We've seen the adoption there. And then we've seen more products come online. Then obviously the features improve over time. Staking becomes more available or more widely available. Then you're moving into, as we talked about, the total return of staking. But then also, I mean, another topic that's, I think is quite prescient is just continued broadening of access through to more and more assets, which, speaks to kind of baskets and index offerings, which are much more diversified and not so concentrated in, say, the top assets that are out there. We haven't seen as much, I think really I'll call it adoption quite of that yet, but it's obviously kind of weighed down by a little bit of the regulatory side, but also a lot of the market side of things because, we've seen the geopolitical volatility. We've seen a lot of the other market dynamics, that have caused this sell-off. And typically the altcoins, those that sit further down the market cap spectrum, selling off a bit. But it's interesting because, the regulatory side is such a key, a key part of all of this.
But just going further with baskets, what I tend to tell investors is there's Bitcoin, store value asset, but if you want growth, you need to invest into other part of crypto space, which is non-Bitcoin. But I always highlight that most of the investors I talk to, they do not have the necessary expertise to identify individual tokens that will be successful over time. Whether it will be one or the other or a third one that will be the biggest and the most successful 3, 5, 10 years from now. It's very, very hard very hard to run the analysis. So for most investors, why take the risk in trying to identify individual altcoins? Why not just go with a broad crypto basket? Why not take the same approach as what they do within equities or fixed income? Because most investors do not try to identify individual equity securities or do not try to identify individual bonds. So why try to identify individual crypto, which is even more difficult because this is much newer space.
Yeah, and I think that's where it comes into, where having the right tool set is so important. So in like say traditional asset management space, you think about essentially kind of benchmarking or at least aligning with a benchmark and then forming your views and making your overweights and underweights. And maybe that's where, the next evolution of things kind of shifts to starting with, say, baskets that are broad-based indexes, or capturing that broad-based index-like exposure, at least as, some portion of, say, the crypto core, if you will, to then being able to overweight, underweight if a person has views, that's allocating towards any specific asset, on top of like kind of as a satellite on top of that existing exposure. But yeah, this is where I think there's, a lot of maturity continue to take place here.
And actually, on this note, let's briefly touch on the blockchain ecosystem as a whole, because people can invest into cryptocurrencies, or they can invest into companies that enable, the operation of the ecosystem. Like, what are your views about that?
Yeah, I think that that's a very important distinction. I look at them as two completely different investment thesis, and I mean, and also, I mean, it's as distinct and as unique as even some of the specific crypto assets as you move down the market cap spectrum. Obviously, we talk about Bitcoin being digital gold. We talk about Ethereum as more of this like smart contract based technology platform that's enabling some of the smart contract I'll say smart contract based applications and protocols that are making a lot of the tokenization efforts, possible. But yeah, so when you think about the equity space, it's nice because it's a bit more familiar. Obviously, you have traditional reporting, you have your traditional revenue, you have your costs, obviously moving down the income statement to the actual net income. So it's nice that you have that familiarity, but the business models can be quite different. But also sometimes, if you start to kind of think about some of the, I'll say more financial use cases, very familiar. So like, companies like Galaxy Digital that are, I mean, now they're kind of moving into, the Bitcoin mining and even AI, um, and, high performance computing ecosystem because of their, acquisition of Bitcoin mining assets that have become very important for these computationally intensive activities. But traditionally really just a key player in the, I'll say, investment banking and asset management side of the crypto ecosystem. So whether it be, offering trading capabilities, custody capabilities for anybody that wants to really get involved in the ecosystem, they really served as that key financial intermediary to really enable a lot of those activities. And then also, I mean, so they're obviously generating revenue from multiple streams there, but then you can kind of just look at your traditional players like everyone's most familiar with the Coinbases of the world. Obviously, the traditional exchange, the fee-based revenue from capturing spreads on the trades, as well as any subscriptions that they might have. But also the new technology that's being deployed, whether it be through perpetual futures and the base blockchain with some of their new collateralized lending, or sorry, their lending or crypto-backed lending services that they've got. So there's a lot of unique businesses there that are generating revenues from crypto-related activities. We didn't talk about stablecoins much yet. We've mentioned them; they're super important. But that's a very easy, simple business model from the high level. You think about it. You issue a, I'll call it a dollar-backed token, and instead of just holding I'll say paper dollars, not generating a yield, you're owning treasuries, you're owning other commercial short-term commercial paper, things that are generating a nice yield, and effectively stablecoin issuers like Circle and, even Tether out there, which is kind of more in the unregulated ecosystem internationally. Um, generating a nice yield that they're capturing that spread. So in a sense, almost like a bank-like or shadow bank-like activity in a way. Um, so there's a lot of unique things there. And then we didn't even really get into Bitcoin miners, which are obviously, we talked about staking, but the Bitcoin miners, essentially doing a very similar thing where you're validating transactions on the network and, rather than say posting collateral to, you know, uh, allow you to do those verifications to make sure you're not, posting anything fraudulent because you would effectively, have your collateral, cut in that case in the form of staking. But when you think about things from the Bitcoin perspective, it's obviously uh, the opportunity cost or the cost associated with doing um, validation on the network is tied to the energy input. So we're all aware of the advanced computing and the application specific semiconductors that are needed to do those calculations. And so that's another business model where, from a Bitcoin mining perspective, it's you have energy costs as your input. Your output is minting new Bitcoin as you generate the subsidy for validating transactions. So, when the price goes down and when Bitcoin price goes down and energy costs are high, like this is where it gets to be a very tough business. And this is why we see a lot of Bitcoin miners kind of moving into the AI space because they can lock in, longer term contracts with, some of the hyperscalers or others out there. So it's a very dynamic space, completely different drivers of the investment, but all altogether related because at the end of the day, a lot of those revenues, as I said, the Bitcoin miners generating a revenue denominated in crypto in Bitcoin, but then exchanges generating revenue based off of volumes. So there is some correlation tied to it for definitely, but two different investment cases driving both of these spaces.
I think that piece is really interesting, actually, given where we stand and what types of products that we have at Wisdom Tree, especially on the European side. So, I question to both of you on that. It sounds like two very different investment theses, right? One built on the cryptocurrency itself, and then the other one on companies leveraging more the technology behind crypto, which is blockchain and how that enables operations, et cetera, et cetera. But how do you guys converge that? I think that's, to me, the question that I receive a lot is Ethereum, for example. There's a lot of companies building on Ethereum, and those companies will or will not be successful based off of their operations. But how do the successful stories kind of relate back to Ethereum from a value perspective? Because you mentioned macro as one factor, but I think the other interesting one is obviously valuation, right? Like, how do companies make money, but in this case, how do we value Ethereum? How do we value Solana? How do we value these chains that are income producing or revenue generating, but um, connecting that with the more real world applications?
I was just going to say that at the moment I'm drafting a new white paper where I intend to outline how investors should think through valuing altcoins. And it's in no way an easy exercise. And it will take me many months, and my draft is due at the end of September. So I'll have an interesting summer just trying to figure this whole thing out. But there are fundamentals of these blockchains that investors can look at to decide whether now is a good time to invest. But how to look at those fundamentals, I just want to find something consistent for different taxonomy buckets. And this is where I'll be spending a lot of time. But Blake, keen to hear your views about this.
Yeah, no, I definitely agree with that. I think, it comes down to because there's tons of metrics out there across all these, and that's the beauty of the blockchain is you have that transparency. You have I'll say the openness of the open access of all the data, all the protocols, or sorry, all the underlying code that actually runs the protocol. So I think that's really where there's tons of advantage in if you're really diving deep to start to analyze a lot of the data and build useful metrics. So fully agree with the Dovile that is a huge thing. Also going to be a very big, that's a very tall ask to be able to do this. So but it's where the industry is going, and it's where the industry I think needs to go to be able to give traditional investors a little bit more comfort in really assessing the fair valuation of these assets. As the way that I think about it, I'll step a bit higher level, um, maybe from a little bit more the philosophical side of things. If I, I'll maybe pinpoint, I'll do two different types of assets. I would say one, let's start with just like the smart contract layer, like, a Solana or an Ethereum, one of those smart contract based blockchains. I generally look at those as kind of more analogous to, I would say, a country or a small economy in a way, because at the end of the day, when you want to interact with a service that's available on Ethereum or on Solana, you need the actual underlying token. So to me, that's very similar to when I'm, if I'm an American, but I'm here in the UK. So when I first moved here, I obviously needed to make sure I had, pound sterling to transact in the UK and make those currency conversions. And obviously, we see the FX rate change consistently based off of, the economic growth, based off of the relative interest rates, all of these kind of key factors that drive, FX across different countries. Now, with the smart contract layers, I look at it similarly. Like, it comes down to, if there's more economic activity taking place on certain blockchains, there's going to be more demand for that currency. So people will adopt that currency as time goes on. And at the end of the day, you're going to need that currency to pay fees on the blockchain. So if, we've seen a lot of activity from tokenization side, then I'm sure, being involved with this, you've seen it kind of converge towards Ethereum at this stage. So with that, naturally, you would kind of think that, oh, more demand for Ethereum from the players that are involved here, because every time they interact with a smart contract or anytime they want to transfer assets across the blockchain, they're going to need to pay those fees. So naturally, people will end up needing the ETH there, and maybe even keeping holding it as a long-term allocation, or a long-term just asset to make sure it's available in that world, to make those types of, or to access those products and services. In the same way that, as American, I still go back. I still have plenty of assets in the U.S., but I still have assets here in the U.K. So that's one thing. So I kind of look at the smart contract layers as more economic systems. To contrast that, I would look at the protocol sitting on top as almost company-like, and this is where the regulatory environment is really important, and where, Vinh, you highlighted it, classification being so important, because theoretically, some of these protocols that are providing decentralized exchanges, lending protocols that almost are kind of bank-like in nature, that you can deposit assets to lend to other individuals, other wallets, to generate a yield, or you could, borrow if you post a certain amount of collateral. So I think, and then obviously these protocols are generating fees tied to that, whether it's capturing a small spread, or just a transaction fee for interacting with the protocol for the exchange. And right now, those fees generally accrue to the protocol itself. But as a owner of the token, you have, if the governance is set up right with these protocols, you would effectively have a vote on how things change with the protocol, and you could vote for these fees to be distributed to token holders, which effectively would be like a dividend, right? So this is where you start to understand or think about, oh, these could be company-like, but this is also where, I would say, rewind 2 years or so from the regulatory perspective in the US particularly, where you got a lot of scrutiny on these types of assets, and they didn't really want to turn on that, I'll say, that fee switch to pay, quote unquote, a dividend-like thing out, because it would flag it immediately as a security, and you'd automatically get maybe a Wells notice or whatever it may be. So there was, I think, a lot of room for, interpretation there. I think there's a lot of good progress there, but this is kind of how I'm separating things out now. But yeah, I think, Dovile, when it'd be great to kind of hear your detailed, ground up analysis. Right now, I'm kind of just giving the top down as I see it today.
And that was really helpful, actually. So super appreciate that, and I think I'm very excited for Devile's write-up now. I will say, I have another tall ask, and I know we're at time here, so one last question for both of you is given the environment now, given the geopolitical risks that we're seeing and just the uncertainty around markets in general, but especially crypto markets being, that's what we all are focused on. Give me a reason to be bullish or don't. And based on the macro case.
So based on macro case, the key reason to be bullish is the endless money printing that's happening around the world. So now different countries have even higher expenses. They're not generating the revenues that they were hoping to generate. What will they do? They'll print money. And how can investors protect themselves? Well, we have hard asset Bitcoin.
That's a good, yeah, that's definitely a strong case for that. That's especially as we see more and more, not as much fiscal restraint from a lot of countries and more geopolitical, um, tension and, the spending that could be tied to that. So, yeah, I echo what you say there, Dovile. I think the other big bullet point I would just highlight is as I said, it seems like it's late if you've been in crypto, for even just a few years. 1 year is like 10 years. It feels like 10 years in crypto. So so as we continue to see, I'll say the broad-based, adoption continue in the institutional space, I think that's one thing that does serve as a major tailwind. And we've seen the impacts with the reduced volatility just as a, one key bullet point. And then even the conversations we highlighted earlier, whereas if you would have rewinded 2 or 3 years, I mean, really, I guess in 2020, January 2024 is when really broad-based access became really easy to access crypto because it started running, as we said, you took the new wine and put it into the old wine bottle, which was available to everyone. And that's really was the starting point. We've seen those conversations shift from, really high level to now very detailed conversations, like as we talked about with staking, the total return difference, all of these types of things. So I really just look at that adoption curve continuing. And then, as we talked about today, the regulatory side of things, particularly in the US with the Clarity Act and tokenization, like in Vinh, you highlighted the convergence. Like, I think you start to see as we get more regulatory clarity, more adoption, we'll start to see traditional markets converge with crypto. And there'll still be, different things, different investment cases, all the kind of nuance that's naturally tied to this. But at the end of the day, we won't necessarily be, having a conversation that's like separate from traditional finance. It will be very much all a part of the same thing. And we'll just be addressing all the key factors and key valuations and all the stuff that, we have now on the docket here in the months ahead.
Yeah, no, thank you for that. And if you're listening, please, now you know why you need to be bullish. So,
To clarify, the views and opinions expressed in this podcast are those of Wisdom Tree and are subject to change. Anything we present in this podcast is not intended to be relied upon as a forecast, research, nor as investment or tax advice. The information and opinions expressed in this podcast are not recommendation, offer, or solicitation to buy or sell any securities, and reliance upon them is at the sole discretion of the listener. Please remember, past performance is no indication of future results.